That's closing bell on Wall Street, and now it's market domination overtime. Getting your full team coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery joining us here to break down the moves today. Jared, walk us through that close.
Thank you. A lot of red here, but it's not a disaster. Just seeing some mild losses in the Dow, NASDAQ, and S&P, all down about 3 to 0.4%. I will show you the intraday price action first on the Dow. That's actually year to date. Here we go. Closed pretty close to the lows, but we just drifted down into the noon hour and then stayed at those levels for the most part for the remainder of the day. Here is the NASDAQ, was a little bit more in the red, and you can see a little bit more off of those lows. And the S&P 500, similar to the NASDAQ there. Also point you to the S&P 600, which lost a little bit more, down about 86 basis points, or rounding up to 0.9% at the lows there of the day. And let's skip over to the sector action, where we see energy in the pole position up 1.3%. That's on the back of the best two-day crude oil rally, that's WTI, that we've had since the end of July. What also was working today, utilities, consumer discretionary, and then the other consumer sector, consumer staples, that's XLP. So all of those outperforming, along with financials, which was a little bit in the red there. And then leading the way down was materials. And I'll also show that real estate down about 1.02% as well. Inside the NASDAQ 100, Tesla, a big standout. You can see Tesla up about 4% right over there. Intel also up 6.4%. Marvell up 7%. And so we saw a few big names making some moves today, but for the most part, a little bit more red than green. And let's take a peek inside the tech sector. We'll first check out semiconductors, and let's make this an equal weighted performance sorted showing here. Marvell, we just talked about that, and Intel up 7% and 6% respectively. To the downside, it looks like light, that would be Lumentum Holdings, down about 6.85%. And then within the software industry, let's get rid of the market cap weighting. There we go. More red than green. EA down almost 4%, and then just a few names in the green to the upside. And I did show China as a bright spot before, worth highlighting once again. Alibaba up 8%. I believe that's multi-year highs there. Baidu up almost 6%. JD up more than 5%, and the list goes on. So China, one of the bright spots today, and really not historically correlated with U.S. markets over the last few years. Josh?
All right, thank you, Jared. The stock's closing lower for a second day, but overall, we've been seeing a rally led by tech and AI. My next guest says markets could go higher from here and has a near-term playbook to help rebalance your portfolio for gains. Here with more, we have Marta Norton, Empower Chief Investment Strategist. Marta, it's great to see you, especially on set. Let's talk about areas you would trim. And one area you would trim, Marta, would be AI. How come?
Yeah, it's really that AI theme that's been such a driver of the market overall, and of course of the name specifically, technology as a sector in particular. And when we take a look at where valuations have run, of course they got cheap on April 8th, but that was just a momentary stretch of time, and then we've been back up to these very high valuations. And of course, as soon as valuations come up, everyone says valuations are not a timing indicator.
Right.
Except when they're at extremes. And when you take a look at when they're at extremely expensive levels and extremely cheap levels, that's when you start to see them become predictive of 3-year returns. And so at these levels, you could argue that we could see weaker prospective 3-year returns in areas that are at these extremes. So that's on the list.
What do you think more broadly, Marta, as just someone who's been studying the markets a long time, the kind of AI spending bonanza, which has investors so excited? If you're a company, you just have to say you're going to spend, and people bid up your stock.
That's right.
The dollars being talked about, they're historic, right, Marta? And I'm just wondering, do you have confidence in that, and think, you know what, it's all going to work out? It's all going to, in the end of the day, it's going to generate real material revenue and profits. It's going to be fine, or no? Or do you have concerns? Where do you land on that?
Well, as we think about the AI theme, there has been some encouragement this year that doesn't just relate to the CapEx spend. So if we're looking specifically at the hyperscalers, and we're looking
those cloud giants,
and you're looking at the cloud revenue that they're generating, it's been a pretty meaningful step upward. A lot of it related to customers running AI workflows on their infrastructure. And so that's a sign that there really is demand from the broader economy that gives credibility to AI. But when you're talking specifically about the AI spend and this idea that even just the gesture of putting a ton of money behind AI is something that investors are really enthusiastic about, that should give us a bit of pause, because we know that
because it indicates what to you, Marta?
Well, capital expenditures, especially at these high levels, can go awry. They're not necessarily always, perfectly sized and in the perfect direction. And in fact, historically speaking, when you've seen big CapEx cycles, a lot of those companies are penalized. Think energy companies, think some of the telco companies. It can be an actual burden for some of these companies. And so there's a lot of expectation in the market for them to get these investments right. And that's not always the case.
So if I'm trimming AI, Marta, and I'm rebalancing my portfolio, what am I rebalancing into?
Okay, so there's not a ton of valuation in the market or valuation opportunity today. And so it's not just technology that's at these peak valuation levels. It's also areas like industrials, financials, areas that make up the value end of the spectrum. There are only two exceptions, at least in the US, and they relate to healthcare and they relate to small caps. Now, both of these areas have real problems. It's not as though it's, a perfect story for either of them. When healthcare, you have policy concerns. With small caps, there's a weight from tariffs, there's questions around the economy, and they're very economically sensitive. But that's somewhat in the price for both of them. So if you're looking at how do I find value, how do I have a little bit of that valuation exposure within my portfolio, healthcare and small caps are two of the places that you can hunt.
There have been strategists on this show, Marta, banging the table on small caps.
Yeah.
And I guess their thesis really just comes down to, hey, I'm betting they say the economy looks to be hanging in there.
Yeah.
And Powell's cutting.
I think the argument too, of course, small caps have more debt exposure than some of their larger cap brethren. So the argument being that if we start to see rates come down, maybe that improves their fundamentals a bit. And if the economy stays strong, you also have their economic sensitivity that should help lift them up a bit.
I mentioned Powell. What did you think? Our Fed chair was talking stock prices. You saw this, and he said, fairly highly valued.
Yeah, it's interesting.
What do you make of that?
I don't know, maybe he's just been talking to his broker, but he's also saying something that I think a lot of people are echoing. You hear that on
things
almost
feel stretched?
that things feel stretched. I mean, people are running, and I hear people, there's a lot of justification for it, of course. We've had very strong earnings. There's a lot of even fiscal stimulus, putting tariffs to the side, but you have the One Big Beautiful Bill Act, the 100% expensing, you have deregulation, you have, healthy debt levels for at least consumers and for businesses, not so much for the government. So I think people are saying, where's the problem spot? I don't see one. And I guess my point is that with valuations, it's like operating with a low immune system. It might not necessarily be a risk in and of itself, but it doesn't give you a whole lot of protection from the risk when valuations are this high.
And those who stay long the market, Marta, they'll come on here and say they acknowledge things feel stretched.
Yeah.
And I guess what they'll say is, okay, we're stretched, but they'll say earnings are solid, the economy is resilient, and Powell's cutting.
That's right. That's right. And all of those things are very much true. I guess I would also say they're all in the price. So if we're thinking about what drives stock prices, of course your income, and then you're looking at earnings and you're looking at valuations. Valuations can expand here. They were higher at the end of 2021, but they're definitely at the higher end. And so there's probably less room for expansion here than maybe there was on April 8th. Earnings could drive it forward, but they would have to be pretty solid because people expect good earnings at this point.
The Fed cut by 25, was that the right call in your opinion?
Well, I certainly didn't want to see a half percentage point cut.
You didn't.
I did not.
Dr. Myron did.
I know a lot of people wanted to, but I guess what I come back to is when you think about the framework that Powell and other central bankers lay out. Mario Draghi said, small steps in a dark room. You don't want to engage aggressively on monetary policy unless you're in a crisis. So to me, a half percentage point cut would either say that they made a mistake, at the prior meeting, which is a possibility, or it would suggest that we're in a crisis. And I don't think our labor market, at least with the data we have thus far, is crisis data. And of course, there's inflation.
We're debating now what the pace of cuts looks like ahead. How dependent is the stock market on those cuts?
We have seen over this cycle the market be ahead of the Fed almost every time rate cuts are a topic of conversation. And the market has had to come back to where the Fed is. Despite that, it hasn't necessarily unraveled the market rally. It's just been kind of this recalibration. So I'm not sure that a slower pace of cuts would necessarily unravel the rally. I just don't think it would fuel it anymore.
Marta, great to see you, especially on set. Thanks for stopping by.
Absolutely.
Gold just hit fresh highs and money is rushing into ETFs, but the true wild card is still asleep. If volatility wakes up, this move can shift into overdrive, and that's what we're talking about in today's Stocks in Translation. Let's begin now with a chart of gold going all the way back to 2019, and we can see that midway into 2020, gold had rallied to a fresh all-time high that topped $1,900 an ounce. But it would be another 3 years before gold would truly break out and rally again. But all of these years of sideways chop would provide fuel for the next rally higher. And we can see three distinct ceilings that emerged recently as gold stair-stepped higher. And according to the work of Todd Sohn at Strategist ETF Research, ETF flows have been confirming these moves. But even though we've seen some spikes of money rushing into ETFs, it hasn't quite reached euphoria levels that has capped gold prices in the past. So in other words, there could be more room to run. So how far can gold rally? Let's zoom out with a longer-term chart of gold futures, which stretches all the way back to 2000 this time. And we can see here how gold rallied for a solid decade from 2001 to 2011. And remember that sideways action from the prior chart? That was only part of a larger sideways trend that lasted about a dozen years. And you can see that between the two dotted lines here. But at the right of the chart, focus on that now, notice the strength and slope of the current breakout from that box. The trend line is very steep, so there will be pullbacks, but the initial thrust is very strong, and we're up about 250% from those 2016 lows. That's not even half of the 650% move that we saw earlier this century. Now, let's take a look at some of the factors that's propelling gold higher right now. First up, central banks. They have been the biggest buyers of gold over the last decade. China and Russia, they started de-dollarizing in the teens, and now other central banks have been piling on. If central banks paused or actually sold gold, that would be a major headwind for prices. And we just talked about the recent ETF bid. It's not quite as important as central bank buying, but you don't want to see sustained outflows. Then we've also got dollar and government treasury yields. A weaker dollar and lower rates, those generally support gold prices. And 2025 has all been about dollar weakness, which is bullish. So right now, longer-term rates are a little bit elevated, and some investors are going to dump gold and buy bonds to lock in those higher rates. But the Federal Reserve is cutting once again, which is generally bullish for gold. Also, gold can benefit as an inflation hedge and an Armageddon hedge. So geopolitical uncertainty and higher inflation, they can be bullish for the yellow metal. Now here's the kicker. We've got one more chart of gold futures over the last 5 years in white, and we've added the ticker for gold volatility in blue, which is GVZ, which you can find on the Yahoo Finance app. You can think of GVZ as the VIX of the gold market. It's based off gold options, but unlike the VIX, which tends to move opposite stock prices, gold volatility tends to rise and spike higher as gold prices rally. So GVZ is relatively quiet right now, but if it starts lifting with gold prices, that can start a bullish feedback loop. So to monitor the gold fuel gauge, watch those gold flows in GVZ. If they get truly extreme, then watch out for a pullback in price. And we probably won't get any big reports of central bank gold buying until about early 2026, but keep that on your radar. Then also watch the dollar and rates. Lower tends to be bullish, higher leans bearish. Finally, if you like to trade the day-to-day swings, watch for surprises in the monthly inflation reports. Geopolitical headlines can also move gold, but you really don't know when those are going to strike. Bottom line is, gold prices and flows are already in gear, and the wild card is volatility. And tune in to more episodes of Stocks in Translation. We've got new episodes dropping every Tuesday and Wednesday on the Yahoo Finance site. You'll find them there or wherever you find your podcasts.
San Francisco Fed President Mary Daly making keynote remarks on the outlook for the U.S. economy at the University of Utah. This comes amid a slew of Fed speak this week. And Yahoo Finance's Jennifer Schonberger joins us now with the very latest. Jen.
Hey, Josh, that's right. San Francisco Fed President Mary Daly speaking right now, saying she fully supported the Fed's decision to cut rates by 0.25 percentage point last week and said it's likely further interest rate cuts will be needed. Speaking in that speech just now in Salt Lake City, Utah, Daly saying, quote, moving forward, it is likely that further policy adjustments will be needed as we work to restore price stability while providing needed support to the labor market. This comes through in our most recent projections released last week, but these are projections, she cautioned, not promises. Notice Daly not pinpointing just how many rate cuts she expects to see for the remainder of this year, but there was a plural, there was an S on policy adjustments. And Daly has expressed concern about the strength of the job market, saying today in today's speech that there have been noticeable shifts in the balance of risks. Along those lines, we heard Tuesday from Fed Governor Michelle Bowman, who has expressed concern about the job market as well, but perhaps a bit more alarmist than Daly. Bowman warning that the job market could deteriorate, quote, significantly in the coming months, and there is, quote, a serious risk that the Fed is behind the curve here. She noted that if the job market continues to deteriorate, or we see data along the lines of what we've seen over the past couple of months, that she would advocate for rate cuts more frequently and in larger increments. Contrast that with what Fed Chair Jay Powell also said on Tuesday, in which he's not as alarmed about the labor market. He's looking at both sides of the Fed's dual mandate, non-committal when it comes to the policy outlook, saying that policy is not on a preset course, and acknowledging the challenges of both sides of the Fed's mandate, sticky inflation and weakening job growth, saying that there is no risk-free policy path here. Josh?
All right, thank you, Jen. Well, could Apple take a bite out of Intel? Bloomberg reports saying the chipmaker approached Apple about securing an investment in an effort to bolster a business now partially owned by the American government. Shares of Intel rose on that news, and Apple did slide a bit. The two tech companies have reportedly discussed working closer together, but the talks are reportedly in very early stages, and there's no official word of an agreement. Intel CEO Lipton has been said to be looking for partners as part of a turnaround bid. If Apple and Intel were to strike a deal, it would follow the $5 billion commitment announced recently by NVIDIA. Well, European car buyers are increasingly turning to China over America. A new study shows nearly half of consumers in Europe would now consider a Chinese-made car, and that's a complete reversal from last year when American brands were favored. Our senior autos reporter, Pras Subramanian, joins us now. Pras.
Yeah, Josh, really interesting stuff here. You mentioned that survey. You know, are things like Trump's trade war, the Elon Musk effect, backing sort of right-wing parties in Europe, affecting or damaging American companies, in particular automakers here. So basically, a study done by Escalent found that European buyers there, in 2025, 47% of those buyers would consider a vehicle from China, whereas now only 44% would consider an American automaker. So those numbers flipped from last year when it was 31% for Chinese vehicles and 51% for Americans. So, also in consideration for automotive brands from various other countries also increased year over year. So it's not just, a one-time thing. It's the U.S. being the lone exception here. Escalent's VP of powertrains tells me that geopolitics is most likely behind this sort of reversal in reputational damage, whether it's trade wars or things like that. That maybe you can assign blame to the changing taste. But one caveat here, Josh, is EVs, because in China there are a lot of Chinese EVs available, whereas they're not so much in the States. And because European buyers are more open to EVs, it could be explained why they are more open to Chinese vehicles, because they're generally cheaper and their quality levels have been improving recently.
So geopolitics may be one reason, Pras. I'm wondering also maybe what role just more basically price could be playing. I mean, are Chinese cars, would they be assumed to be cheaper, Pras?
Yes, 100% yes, that is a factor in this. The onslaught of Chinese EVs in the country, they're coming in at a lower price, even though they are tariffed in Europe, but not to the extent as in America, which is 100%, and that's why you don't see them here. There's definitely an angle of, yes, the price is right for them, for people who want EVs, and also plug-in hybrids, which are offered by BYD. But the sort of ongoing thinking is that because the trade war is sort of ramping up and hurting America's sort of image in the global stage, especially the Europeans, who are seeing current tariffs of 27.5% of their goods sent to America. 15%, yes, that's the deal, but it still hasn't been signed yet. Might be some sort of erosion there of the goodwill that American companies used to have on the subcontinent.
Pras, thank you, buddy.
Thank you.
Time now for To Watch Thursday, September 25th. We're going to start off on the earnings front. Some big names reporting on Thursday, including Accenture, Jabil, and Costco. Costco announced results for the fourth quarter that comes after the markets close. Analysts expecting Costco U.S. and Canadian stores to do well, and overall sales to rise mid to high single digits in Q4. But international sales have slowed for 3 straight months, hitting their weakest point in almost 2 years. And taking a look at the Federal Reserve, we're going to be getting a big batch of Fed commentary on Thursday from at least 7 Fed officials throughout the day. This comes after Fed Chair Jay Powell on Tuesday said weakness in the labor market is outweighing concerns about stubborn inflation, leading to the central bank's decision to lower rates at September's FOMC meeting. Moving over to housing, some fresh housing data coming in on Thursday with existing home sales. Economists forecasted sales to dip to an annualized rate of 3.95 million, signaling a slight cooling in the housing market amid elevated mortgage rates and home prices. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.